Unveiling hidden risks. Understanding the drawbacks of passive investing in index funds. Passive investing in index funds, particularly ETFs, has gained significant popularity in recent years due to its simplicity and low-cost nature. This investment strategy allows investors to gain exposure to a broad market index. However, it is crucial to understand that there are risks associated with this approach that may not always be disclosed by financial advisors. In the next few minutes, we will explore the hidden risks of passive investing in index funds and discuss strategies to mitigate these risks. Systemic risk. One of the primary risks associated with investing in index funds is systemic risk. When you invest in these funds, you essentially invest in the same stocks as everyone else who holds them. Consequently, during a market crash or significant downturn, all investors may start selling the exact same stock simultaneously. This can trigger a domino effect, leading to a further decline in stock prices. It is important to note that even though market crashes present opportunities to buy stocks at lower prices, individuals often sell their holdings due to financial needs, limiting the chance to take advantage of these opportunities. Individual company risks. Passive investing in index funds does not provide protection against individual company risks. Even if you have a diversified portfolio of index funds, you are still exposed to the risks associated with the underlying stocks. If one of the companies in the index experiences financial difficulties or goes bankrupt, it can significantly impact your investment. Therefore, it is crucial to diversify your investment portfolio beyond just passive index funds. Mitigating risks. To mitigate the risks associated with passive investing in index funds, it is essential to diversify your investment portfolio. Consider including other asset classes such as bonds, real estate, or international stocks to spread your risk. Diversification helps reduce the impact of any single company's financial difficulties on your overall investment. Additionally, actively managing your investments and regularly reviewing your portfolio can help identify and address potential risks. By actively monitoring your investments, you can make informed decisions and adjust your portfolio accordingly. This approach allows you to stay ahead of any potential risks and take advantage of market opportunities. Conclusion. While passive investing in index funds offers a simple and cost-effective way to invest, it is crucial to be aware of the risks involved. Systemic risk and individual company risks can impact your investment returns. To mitigate these risks, diversification beyond index funds and active management of your portfolio are essential. By incorporating other asset classes and regularly reviewing your investments, you can potentially improve long-term investment performance and safeguard your portfolio against unforeseen risks. While passive investing in index funds offers a simple and cost-effective way to invest, it is crucial to be aware of the risks involved. Systemic risk and individual company risks can impact your investment returns. To mitigate these risks, diversification beyond index funds and active management of your portfolio are essential. By incorporating other asset classes and regularly reviewing your investments, you can potentially improve long-term investment performance and safeguard your portfolio against unforeseen risks. As always, do not forget to like and subscribe to our channel, All Things Money, to see more content like this.